Hello, David Moore, Equity Advantage, and I've got Robert Smith of Peregrine Private Capital here today, and we always have a great time doing these things.
We have a good time.
So it's not like it's work. I mean,
No,
it's just it's playtime.
It's
but
fun.
But hopefully we're getting some good material out to you and the audience. And by the way, if you've got questions on any aspect of what we're talking about today, please don't hesitate to reach out. You can reach out to Seymour at 1031exchange.com. She creates our content. She'd be happy to address any questions or any ideas for topics moving forward, DSTs or anything else. But today we're talking about DSTs. We're talking about what's going on in the market, what we're seeing. And obviously we've got people moving a lot of assets, and now you look at the stock market the last few days too, and everyone's talking, we're getting ready for Thanksgiving, who's going to be able to afford the turkey and everything else that's going on, and get the tickets to get there and buy the fuel to get there, right? So, with that said, we're all talking about inflation, but we've talked a little bit about stagflation too. So, Bob, what are your thoughts on inflationary market we're in and stagflation as well?
Well, we were the first ones in the DST space about 2 years ago to start warning potential investors about inflation. And we were roundly derided as alarmists at that time because the masters of the universe, Janet Yellen, Ben Bernanke, Jerome Powell, this couldn't happen. This was a dim, distant part of the past and would never happen again because they wouldn't let it happen until it did. And these are the same people now that are telling you that it is temporary. They were wrong then, they are wrong now. It's structural, it's in place. Actually, very few economists understand inflation well, what brings it on and can end it. So the ability to deal with this on the part of central bankers is very limited. And so I think inflation, now that it's here, is the most important consideration for income property investors going forward because it's going to impact or should impact your property choice. Reason for that being is ultimately as inflation gains momentum, interest rates are going to have to go up. And like bonds, if you're not in a position with your property to increase rents in a roughly commensurate manner, then the likelihood of your increasing equity or building equity in that product goes down. So it's very nice in an inflationary environment or preferred an inflationary environment to have some kind of operating asset, meaning an apartment building, senior living home, anything with lots of tenants and relatively short lease intervals, where assuming that you can keep it fully occupied, you can push rents in an aggressive manner. That simply increases the likelihood of a good ending when the property is sold. And in addition to that, I think there's a very real concern now, not only of inflation, but the inevitability or the possibility of stagflation. And stagflation isn't part of most young people's life experience. If you're under 40, you have no experience with it. Our last great stagflationary epic, late 70s, early 80s, and it's really the worst of all possible worlds when you have an economy that's stagnating or slowing down, which is what we have now. The Biden administration inherited a very robust economy, but because of regulatory overreach, the economy's already slowing down dramatically now. But at the same time, having printed and distributed more money than God over the last 18 months, you have very significant inflationary pressures. So that's the worst of all possible worlds. And so I think that to me should be an investor's primary consideration when considering property types, because if you've got an economy that's slowing down, certain property types will suffer. Other property types should at least hold their own in an environment like that. Does that make sense?
Yeah. So as far as hedging that, and as far as you've got we talk about the time you've been in the DST tick space and how DSTs got started, and now we're talking about a little over 20 years ago now, right? But if you look at people's ideas, the initial aversion to them, I guess, when I would first talk to people about them, is the lack of control they'd have. And then they want to be able to go see the things, right? So they want to be able to drive by it. And my dad always used to say, he didn't want to drive by it with his tennis buddies and be proud of what he's got there. And yeah, exactly. And we just, Dad, it doesn't really matter. You just want it to be doing what you need it to do. Whatever numbers you're needing, you figure it out and make sure you're buying it and you go through that plan. So, but if we look at going forward, and you look at the pressure that's on that DST space right now, the number of sponsors, let's say last crash, post crash, and I'll just say pre-crash this time. Where are we in that space? And I guess if you're looking at going into a DST, I mean, understanding who that sponsor is and what their history is going to be a critical element, especially when you're talking about the inflation or stagflation and how they're going to hedge that. But how that sponsor's, working, making their money, making you money, doing that's all critical.
It's absolutely critical, David, not only the property type, but the sponsor. And we've beaten this home, or continue to beat it home on our website, that when you are handing the keys to the kingdom to somebody else, it's not just a question of what the property and where it is, but who's driving that property. Because in a challenged environment, good management can make a difficult property work. In the same environment, bad management will more than likely make the property fail. And since 2008, all interest rates have done is go down because prices have been stable. We're transitioning out of a low interest rate, stable price environment to an inflationary environment with price instability and ultimately higher interest rates. That's going to be a much more challenging ownership and management environment. So knowing the background of your management team, how long they've done it, whether they were around during the last crisis, what they did in response to that is very, very important. Unfortunately, right now, a majority of property sponsors in the DST space are newly minted or post-2008, and a majority of people selling DSTs are newly minted post-2008. So they've never really been through a down market. That doesn't mean that they're not bright, they're not able, they don't have integrity, and they don't bring good product to market. I just think it's because we're changing from one era to another. I just think it's a very prudent thing not only to know your property type, but to know as much about management and what they do or how they perform when things get tough. It's just a good hedge against the increasing uncertainty that we're seeing from an environmental standpoint now.
So historically, and everybody that's watching this, if you've seen our other videos through the years, one of the things I was always taught is to answer 3 questions before you ever buy anything. What am I going to make? How am I going to make it? When am I going to make it? And that's one of those things where obviously selling what you sell, that whole past performance isn't any indication of da-da-da-da-da. And, fortunately, that's not my space to deal with. That's yours. But it's important to understand how that's going to happen. I mean, what is being projected as a return and how that's going to happen, and going through the period of time that I think both of us are pretty comfortable with our assumption it's going to happen. The company's ability to address this current economic scenario is critical. And if we look at historically, capital gains taxes and our ability to defer it through 1031, you're looking at a situation where you're, creating value over time. But right now we're seeing tremendous jackups in value just based upon an inflationary situation we're in. And so whether we're talking about the universal exclusion, the 250 or 500 that was put in place in 1997, I mean, what should that be? 121, the universal exclusion for a home probably ought to be $1 million, $1.5 million today, right? I mean, if you look at it, I mean, we started off talking the last segment about that $2.5 million, 2,000 square foot house in Redwood City. I mean, it's a different world that we're in. And meanwhile, you made a comment just a second ago I think it's really important for people in the audience to understand. You commented about that management, that company's ability to address things, to bump the rents, do whatever they're going to do. And so many places, especially in the West Coast, if we're looking at this market and the inflation we're seeing and the landlord's inability to actually raise the rents to a level that keeps things working for them. I mean, they don't have the ability to do it out here.
No, and that's why you're seeing this mass exodus of ownership and money off of the West Coast or the left coast into red states, which are much more user-friendly from a landlord and property rights standpoint, because, as you just mentioned, inflation's had a tremendous impact on housing values. And it's actually, all this money that they dumped on the global economy, I think, between the European Central Bank and the Fed, they've been pumping almost $250 billion, $237 billion a month into the global economy for almost 2 years. So there is more money than there are places to put it. Ergo, the financial markets, securities markets, have had to invent investments where they didn't exist before. 6,000 cryptocurrencies trading, fungible tokens, all these things that have no intrinsic value, but that have value imputed to them because there's too much money and too few places to put it. This has caused home prices to skyrocket, to stay in front of most people's ability to buy it. That has, at least for apartment owners, the positive impact of creating or continuing strong demand for multifamily properties and significant rent increases, or the ability to increase rents in those markets where you're not handicapped. And most of those markets, whether you like it or not, are in red states. They're not on the West Coast. They're not on the East Coast. And so it's critical to be able to, if you're going to stay ahead of the game in an inflationary environment, you've got to own assets that you can control and drive in a manner that is commensurate with the economic externalities.
So one thing I want to sort of bring up is just what I'm seeing with our clients too. I mean, we do, as you know, we've got a sister company, IRA Advantage, that does self-directed retirement accounts. And a fair number of our clients on that side of the business had been buying short-term rental, doing the VRBO, Vacasa, that whole deal. And it was working very, very well for them. And then certain states or cities would go in and pass a law. And for example, Portland passed a law that you can't do VRBO unless it's an owner-occupied property. So, in a market where you don't have much rental, you've got now the city or state or county putting rules in place that reduce the available rentals. Because our clients in those situations, obviously, if it's IRA 401k owned, they can't occupy it. It can't be owner-occupied, and so they end up losing those rentals. But the reason they're doing that is they're seeing more. I mean, we're seeing employers using employment contracts, short-term stuff, to avoid some of the laws that some of the things that have to be done for a full long-term employee. We're seeing the same thing happen with the rents in different regions. Short-term rental. I know that I was talking to a client yesterday that was comparing a property here in the Pearl and one in San Diego, and we were talking about that law on the VRBO stuff, and he said, well, San Diego is putting some similar laws in place. They're only going to allow so many short-term rentals. Well, you look at Mission Beach, you look at all those areas, that's what it is, short-term rental. You're not looking at seasonal type stuff, but it's changing, and it's really, they're messing with us completely all the time. And so I think really you've got to look at what you're doing, how you're going to control the assets you've got, what you're vulnerable on, and how you're going to fight it. And if you're just done with that, you're tired of it, where are they going to go?
Well, I think you hit the nail on the head when you use the word control, and you used it earlier in conversation. And that historically has been the principal hurdle that property owners have to get over before they can transition into the DST format and remote management. And whether you like it or not, control on the West Coast, where we live, is an increasing fiction, because you may technically own the property, be obligated to pay taxes on the property, be liable for anything that happens in and around the property, but increasingly you have little or no control over what you can do with that property, though that's been usurped by state and local governments. So that obviously is one of the advantages of DST, is that in a changing economic environment where you have to be able to change things with regard to your property and its rental disposition to stay ahead of the curve, it's probably to investors' advantage to transition out of this environment and exchange into an environment where there is less regulatory burden, where that control has not yet been usurped by governmental agencies. And like it or not, that's red states. And that's why people, money, and business continue to move there. You mentioned before we even started this that, Nancy Pelosi, of all people, is house shopping in southern Florida. So the people that have created this regulatory nightmare don't even want to participate in it or be subjected to it. So why, as a property owner, should you be or continue to be?
Yeah, I've got my buddy, the rocket scientist, he's living in Destin, Florida. He goes, David, when are you going to move? Come on, hey, look at it here. We don't have to do this. We don't have to do that. And I go, Matt, that's why you're the rocket scientist. So anyway.
It's making more sense all the time, partner.
Exactly. So once again, David Moore with Equity Advantage, Robert Smith, Peregrine Private Capital, and we're just talking about DST's inflation, stagflation, and what people are doing today. Thank you for joining us. We'll be right back.
I know you didn't read my heart. You didn't even read my story. Good girl, good these stars. I can see straight right through